To start. All right, I think we're live, everybody. Good morning, good afternoon, good evening, everybody, and welcome to another D Brown Consulting webinar. If you are here, can you type in the chat? Just tell us where you're chatting from. Let me type my name. I am David from Lagos, Nigeria. Okay, where are you connecting from? Tell me. All right, let me see who is online. Tell me where you're connecting from. We have started the webinar. If you look at me looking left, or is it right on your own end? I'm looking at two screens. I have two screens. Right. Let me see. Tayo, is this correct room for the webinar? Yeah, Tayo, if you're here, this is the correct room. Say something. Tell us where you're connecting from, Tayo. Common valuation mistakes. Yes, Tayo. Common valuation mistakes and how to avoid them. Tell me where you're connecting from, Tayo. Where are you connecting from? Tayo is on the line. Okay, we have Carla from Lagos, Nigeria. We have Ayodele from Lagos, Nigeria. Tayo, you haven't told us where you're connecting from. So welcome, everyone. Welcome to the webinar. Today, we're going to be talking about common valuation mistakes that people make. And in the house, I'm going to introduce him very soon. We have a very experienced valuation expert, right? He's a consultant. He's done so many valuations. So we're going to get some insights from him. And yes, let's move on. So our sponsors for today, as usual, is D Brown Consulting. D Brown Consulting, I'm the managing partner of D Brown Consulting, and we actually, what do? We do training and consulting services. We take data, we help you make sense of your data, we help data sync for you, we help you make data-driven decisions with your data, right? And that's why we build analytic solutions, we also build financial models, we do valuation, we just help automate that data process. Anything that data needs to do for you, we help you automate it. And guess what? We now have AI, right? So we get your data organized so that AI can use your data efficiently to help guide you. So that's what we do. We've been doing that for 19 years now, right? Well, our clients all over the world. We have clients from all over the world, World Bank, we have Autodesk in America, we have Procore, we have all sorts of clients, and of course, lots of banks, consulting firms, and basically anyone that wants to do a lot more with data, wants to do a lot more with Excel, Office, Microsoft. We're a Microsoft shop, so we use mostly Microsoft products, but make it super simple for you to effectively use your data, effectively be more productive. So we have clients from all over the world in the last 19 years. And who are our strategic partners? Well, we have Microsoft, of course, XBRL, very interesting formats that you can use to understand or structure your reporting data in a better way. IBCS, International Business Communication Standards, and how to do proper presentation of your reports, dashboards, and forecasts. CPD UK, so CPD, a lot of our courses are accredited by the CPD, so you get your CPD credits, ATD, CFA, ZBI, Financial Professional Network, ICANN, ACCA, all sorts. We have various products that we kind of do with our partners. One of them is Financial Modeling Academy. You can check that out online. Right. Who is speaking? I'm David Brown, managing partner of D Brown Consulting. And with me today is Mr. Bolahon Ashagbe. He is the associate director at KPMG, and he is a chartered accountant, chartered tax, I believe, as well, but he has specialty when it comes to valuation. So let me stop talking and let's say hi to Bolahon. So let's see. Bolahon, are you here?
Yes, I'm here. Happy to be here as well.
Hi, Bolahon. How are you doing?
I'm fine. Just a quick introduction. I head the valuation practice, KPMG, West Africa, Nigeria, and Ghana.
So, good. So, head the valuation practice. How many valuers under you?
I do run a team of about 10, core team, but with support from across the other, from another pool of resources, depending on the need.
Okay, and so you both Ghana, Nigeria, and also, I mean, how long have you been doing valuations, or how long have you been building valuation models and advising clients?
I think more like 2011. When I joined PwC for customer to KPMG, I started at 2011. And then I thought I was a valuation expert until you joined a Big Four. Then you realize that what you know, you need to unlearn what you
learned.
Yeah, and see and relearn.
So
There's deeper analysis around this. There's that insight around the numbers. Then also even the report itself, it's more detailed. Providing, walking you through the whole process of how they arrive from the data that you to them to how they arrive at the valuation opinion. That at the end of the day, by the time you read the report, you come out feeling better and more enriched and more knowledgeable, and you understand how they arrive at the value that they have placed on your asset or your company.
Interesting. So you're basically saying that you are making some of the mistakes that you're going to talk to us about today.
I did it. So people don't be afraid. I did it as well. I got it.
So you made all those mistakes. Please, it's been nice when you talk about mistakes. This one I really made it.
I walked them through the one of the most embarrassing one.
Okay, that's going to be really cool.
Interesting.
So yes, we're talking about valuations and mistakes. It's common mistakes that quite a lot of us make, right? And it'd be good to kind of know, okay, how can we avoid this kind of mistakes? How do we do valuation reports that understand you have an idea about these mistakes, therefore you have a process for trying to avoid them, right? So yeah. All right, let me just do some quick setups. We'll be sharing a few slides, I think, and then we will jump into the whole process. So let me do that. Okay, so.
Okay, thanks. So I tried to put together quick slides that I think I will guide the bulk of the conversation. Maybe probably try and ask questions or provide clarity on those mistakes and how I think you can avoid them.
Yes, definitely. So I'll be kind of chipping in. In fact, let me say I'm going to play the devil's advocate. I'm going to play like the devil's advocate here and see how we can. That's the role I'm going to play. And I'll also talk a bit about the modeling section of things, as in, okay, because we do a lot of financial models. And of course, the valuation is one of those outputs of the financial model, a very critical one, actually. So we'll be talking about that as well. So common mistakes in valuation, right? Where do we start from? Could we just do like an overview, maybe for those in the house that don't even know what valuation is? I know we have some gurus in the house. In fact, let me ask a poll. Tell me your level, right? Tell me your level in valuation, as in how deep is your skill? Or should I say what's your biggest valuation issue you think you have? Type it in. One thing issue you have with valuation, type in the chat. So I guess I'll get some of those more experienced valuation analysts, right? Type in the chat. What's the biggest valuation issue you struggle with? Tell me in the chat. All right, so type in the chat. Let's see. Try refresh. Okay, no, someone who's typing. So our gurus are not typing. They don't want to give away their issues to us. They're keeping it close to their chest. Okay, then I was still typing.
It means they're all experts.
They're all experts. So that's why I did another poll. So I did a poll. You can click on the poll. What is your valuation experience? We say never done one. 50%.
You can learn from them as well.
So everybody try and fill out the poll. Let's see who is in the audience, right? Let's see who is in the audience. So we tailor how we talk to who is in the audience. So never done evaluation, click that if you've never done one. Done a few, click. Done a lot, click. You are a master, click. I think definitely. Bola is a master. So, but yeah, so click. Let me wait for that. Let's see. Okay, so the poll currently, they're filling it out. Never done one, they're like 35% of never done ones. Done a few, 56%. Done a lot, 8%. So we have 10% masters here. Well, 10% that have done a lot. Nobody has said is a master yet because I think because you're in the house. That's why.
No. I mean,
if I'm a master,
the way I view this is more around. I mean, nobody has monopoly of knowledge. We all learn from each other.
Yes, we all learn. Yeah, true. Nobody has a monopoly of content, but yeah. So 7%, I think the poll can stop the poll now. We have mainly done a few, about 57%. I think that's good. And never done one, about 35%. And then done a lot. So 35%, never done one, about 65%, at least they've done, but they have an idea. Okay, so we have a mix, mostly people that at least have an idea about valuation. Very good. All right, over to you, Bola.
Okay. So I mean, we'll start first just by refreshing ourselves with what is value, what's valuation, and type of valuation. The type of valuation approaches are out there. So I think from the starting point is when you hear the word valuation, I mean, the starting point should be what do you understand by the word value? So value is like the what or the importance or usefulness of something to someone. That's the value. The process of determining that what is valuation. So you can see the difference. And so in finance, right, they always say value is cash. So at the end of the day, the more cash you have, the more valuable the business is. So I mean, there are three main approaches that you see in doing valuation. Now there are various variants underneath each one of these approaches, but the three broad ones are the income approach based. Now, what that is saying is that the value of a business is based on the cash flows that business can generate into the future. And in this case now, this is where the quality of your financial model comes into play. So that financial forecast needs to be reasonable, needs to reflect the short to medium term view of what that business can generate. And because these cash flows are generated into the future, that is reflected on the risk profile of that asset or that company. So you can see the various variants underneath the free cash flow, there's dividend discount model, residual income model, and adjusted present value. All this leverage the forecast or the financial model that has been built. So oftentimes I always tell people that you need to have an integrated financial model that has your P&L, balance sheet, and cash flow. Let me use the word. So there has your statement of operating income, statement of financial position, and your cash flow statement. Why that? Is that if you have the integrated model, it allows you to have a proper interplay between the P&L, the balance sheet, and the cash flow. So, i.e., when you are building a model, your depreciation schedule needs to be done correctly, because then the depreciation for the year flows into the P&L, the net book value flows to the balance sheet, and your capital expenditure flows into your cash flow statement. You can see the interplay. So if it's integrated, you just don't start plugging numbers in there to just balance the balance sheet. Rather, you have it done properly. David will talk about this more as we progress. But all the three needs that forecast to be done the right way and reflect short-term view of other business, other assets we earn. I'm going to be using the word business and assets. The reason why I'm using asset at times is that upstream business, they tend to use the word assets. They don't call it company. Because then that producing entity is called an asset. So they call it producing asset. So you also do valuation around that as well. So I keep using the word company / asset. You need to know. So the starting point, you need to know what you're valuing and why you're valuing it. Before that will now help you come up with the approach that makes sense. So the other most popular used approach is the market-based approach. These two. income and market-based approach. Now, what the market-based approach is saying is that similar businesses sell for the same multiple, valuation multiple or ratios. Now, what that means is that David buys orange in Ikeja, Mende to precise. He sees, look at the size of the orange and what is paying for them, and he goes home to maybe K2 and uses the same orange. He uses the same kind of like gauge of that size. Okay, yeah. When I was in Ikeja, when I bought this orange, this size for 5, I bought this 5 at this price. So when it goes to K2, he's going to use that same gauge, that eyes to gauge that this one that I put in, this 5 should not be more than this. I will not be more than this. That's what that means. Basically, they're basically using the multiples of similar businesses to value your company they're trying to value. So that is that in a nutshell. Then the third one, so these first two, right? If the business is profitable and has no going concern issues, they tend to use a higher value than the net asset of the business. I'm assuming at least so when I mean net asset of any business is total asset less your current liabilities. So that's a net asset. In that case, that's your net asset is that of shareholders' funds. These two, the first two, income and market-based, if the business is profitable, has no going concern issues, will yield a value higher than the net asset. What that means is that these two always capture the value of intangible assets that exist in the business, things like brand, customer relationship, and the rest, and technology captures those things and assigns a value to it. So that's why the value is always higher than the net asset. Now, the third approach, which is not commonly used unless the business is distressed or the business is a real estate business, is the asset-based approach. Now, what that does is that at the minimum, I can pick up the business, sell all the assets, pay off the liabilities, and what's left becomes my own value. The problem with this is that it ignores any material valuable intangible asset that exists in the business. So they hardly use it unless the business is distressed or is a real estate business. So those are the three approaches. Now, for each one of them, there are common mistakes that are in there. So what I tried to do was to try to, based on each approach, try to highlight some of the mistakes that I see. Is not me. Those are not all that are there, but I just try to pick the common ones. So there are still more than this. So if I don't discuss the one that you've made, it does not mean that you have not made one. But do not be afraid. We won't make that. It's just to learn from each other, and that's why I always say consult. I still consult. I still reach out to friends out there as well, especially when I'm not sure, to just bounce things off them. So the ones for the income approach, so I try to put them in different buckets. I think the first one, can you move to the income approach one? Yeah, time horizon. Now, what does that mean? That is basically, so there's inconsistency between intended period, holding period, or strategic time horizon and cash flow forecast used in the model. What I'm trying to say is that so at what point do you think the business gets to a steady state? So you need, like I said at the beginning, is to sit down, have that conversation with your client or with your boss or whoever is giving the assignment to do, is to understand the business, understand what they're valuing, understand the key value drivers of the business. So businesses like upstream assets, whereby there's a license, doing license, capped, I think maximum is 20 years if you had each time. What that means is that forecast, you cannot have a terminal value. Because what terminal value assumes is that the business is going to exist to perpetuity. In that case, it doesn't work that way. So for that one, the forecast stop at 20 years or the remaining useful life of that license. Or if you are valuing a PPP, private partnership, oftentimes there's a contract signed as well with the time frame. So if it's a BOT, build, operate, and transfer, it's automatically set as well. This Lekki Road, it was that kind of model, BOT, but later on Lagos State bought it off the guy that was working on it because they felt that that the guy was taking too long, and two, the the proposed tariff was becoming too expensive for people. So Lagos just bought it off them. So for that one too, the horizon for your forecast will also be in line with the contract. Now, the other one that also lives is that, so for other businesses, typical marketing business, Guinness and the rest, or Nigerian breweries or MTN, how long should your forecast be before you assume that the business has reached steady state? And that means once the business reaches steady state, the remaining part sits as terminal value. Now, the rule of thumb is 5 years for a business that is operational and has been running for some time. And even under IFRS, I've gotten the IFRS standard, they basically put it as 5 years, unless there's a compelling reason why it should be more than 5 years forecast. Something that is 5 years. But there can be situations whereby and that's very important to also have that conversation with the management or the target they are talking to understand where they are in the business life cycle, understand understand. And so I'm really talking about the recommendations. So it might not be in line with this. I mean, I might not talk in line with the slides, but I'm just already talking about my recommendation. Part of it is to sit down and have that conversation with them. So, i.e., where are you right now in the business life cycle? Are you in the investment phase? Basically means I am spending a lot of money on capex. Yes. How long do you think this capex spend will be? So, if they are going to spend money up to like 4 or 5 years, you can also ask them. So, if you make this investment, when do you start? So, let's say hypothetically, I increase my capacity, my store capacity. Rather than me producing 1,000 shirts, I can now produce 1,500 shirts. I made that spec. How long do you think it will take you before you get to that ability to produce 1,500 shirts? You can't produce immediately. Even if you finish the plan today, you still need to do promotion and rest and what market can accept. So if some will say I need 2 years to get there, so that means you're having 5 years plus 2 years. But nothing is cast. But just to have that conversation is very important. To have that conversation and to understand what you're valuing. So that will help you deal with this time horizon mistakes that is very common. So the next one is focus assumptions. I keep mentioning for the income approach, you need to have a financial model or forecast that reflects the short to medium term view of that business. It's not aggressive and it's not too conservative. I think for this one, I leave to David can provide more context around this, or what you need to just think through and how you need to do this. But this is another big issue that we see. So most times, management tend to be very, 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 very bullish and optimistic. And at the end of the day, you end up with forecast that is not reasonable and is not achievable. And what happens is you end up overvaluing the business. So I think, how do you beat this? David, do you want to provide some additional context on how you think, from your experience, on how you think we can avoid this kind of mistake?
So on the forecast side, let me just come in. So the key thing there is, people need to understand sense checking their model, sense checking the numbers, really. I don't know, there's some models or some valuations that you have where we see hockey sticks. We call them hockey sticks. When you do a chart of the revenue, you do a chart of the whatever, you just see them always going up. Like the whole world everything is always good, always wonderful, right? So that tells you there's something wrong with those assumptions that you're making, right? And you need to have a cleaner look. You need to take some more time to actually look at those critical assumptions. Now, of course, the model data feeds into the valuation. And if you plug all of them together, then it's very integrated. But assumptions are super important. Sometimes you have to realize, that accountants, auditors in the house, there's some numbers that they put at IFRS, mostly IFRS driven, right? But when you're building a model, you need to be driven by what is actually eventually hitting cash flow. What are the true drivers of a line item? Now, if you just take the financials as is and just plug them into your model, you may make a big mistake because you'll be driving them by completely wrong things. Take simple like interest expense. If you have an interest expense line and you think, so interest expense was 200,000. You take your loan and you divide your 200,000 by the loan amount. You have an effective interest rate, right? Now, that could be very wrong because if you go to the notes to the account, you may see that inside interest expense, they've actually loaded foreign exchange loss, or they've actually loaded derivatives. So derivative instruments that reduce the interest rate exposure, so to say. Now, as a modeler, derivatives are driven by something else. Interest expense is driven mostly by interest rates and your loan, right? So if you don't split that out, you're just modeling, you're not modeling reality. And without modeling reality, that's going to flow into your valuation, right? And all your assumptions in your valuation may not make sense. So modeling, getting the fundamentals right, getting the assumptions right at least is very critical. But then there's some assumptions on the modeling, on the valuation side, very critical assumptions that people get wrong. And I'm sure, yes, Bola is going to talk about those. But the modeling perspective, you need to understand that there's a difference between a modeler and an accountant. Accounting numbers are very important, but modeling is more close to finance, and we're trying to understand, okay, what is the true cash flows of this business, right? Your FC, your forecasted cash flows going forward, right? And for that, you need to kind of restructure your P&L and restructure your balance sheet with a driver mindset, as in every line item, what really drives them. Then once you build that model, your valuation picks from that and picks something a lot more valuable. All right, so back to Bola. Let's see what's next.
Yeah, taking a cue from that, I mean, it's like I said, one of the first mistakes I made was that as an accountant, when we're doing Icon and Invest, we're taught that it's good to have a very healthy ratio, quick ratio, or current ratio. That means you need to have higher current asset over current liabilities. But in finance, right, that's not a very smart thing to do. So in finance, you're basically working towards having a just-in-time approach. So basically, your money is not out there, sitting either in inventory or sitting with people that owe you money, receivables. Okay, keeping that down. Yeah. And if possible, you can fund your business rather than taking bank loan. If you think your supplier or the guy that gives you Kenya is very big, you can what's the word now? You can push to have very lengthy repayable days. So you are funding your business using their own balance sheet at zero cost to you. So what that means is that it throws the whole idea of current ratio must be above 1 or 2% or 3% out of the window. Because if you have a current ratio that is not less than 1. So those are part of the things I had to unlearn what I knew and not really start thinking like a finance person. There's also part of the things that you just need to just be mindful of. I think the next one is around, another one that I see regularly is around terminal value. I mean, what that means is that, so right now, so there are two angles grouped together, right? So beyond the forecast period, SP forecast period of either 5 years or whatever it is you end up with, most times by default is 5 years. But in some rare situations where I explain, you might have to extend it by like a year or two, so that the capex that in year 5, the benefit of that will be felt in your cash flow. Is that so? How? For terminal period, right, you need to assume that the business is going to grow to perpetuity as a starting growth rate. So what would that growth rate be? And that there right now, I mean, in Nigeria is all over the place. In other climate, right, prior to the FX collapse in 2014, it was fairly okay and sane. Because the rule of thumb is that Finance 101, back to Finance 101, is that businesses should be able to, so in steady state, you're not making any alpha. What call alpha is that you're not making any additional money above the inflation rate. You're basically, the rule is that you're basically passing your, what's it called now, any increase in cost to your end user. And that's so then inflation was around 6-7%, which was fine. Now, inflation rate is all over the place. I mean, it's now is that we have two rates. The old one of about 30% and the rebased one at 25%. But you can't use that. So the way you get around this is you can use that terminal, we can use that as terminal growth rate. So what you can do and what I've seen people do is that you And that challenge is that if you can get data around what's the long-term growth rate for Nigeria, right? So places like EIU has it. They give you a long-term growth rate from like 20 people, what that long-term growth rate looks like. So the view is that that's a steady state long-term growth rate for Nigeria. That's one approach. The other approach is to try and it sounds like a little bit complicated. What I'm saying is that between the Nigerian local bond and the Euro bond, what's driving the differential is the long-term inflation rate for Nigeria. There's a complicated calculation around that. So maybe in your quiet time, if you can lay on around that, what's nominal and GDP growth rate, on how to derive that, you can go and for that reading around that. Where I'm going is that
okay, so I wanted to put a wrinkle in what you're saying. What about VC, venture capital, right? I mean, take Google when they started. I'm sure we would have said, okay, we're going to value you. You're probably growing at whatever percent, but you go to steady state at 5 years. And then they basically are what trillion or something. I mean, they've grown crazily. How do you manage valuation for VCs, right? Venture capital. Because this terminal value is such a big thing.
It is. Typically accounts for like 60 to 70% of the value of the business using
exactly.
So everything goes back to for companies like Google, right? Is to sit down and have a conversation with them that you are growing rapidly. In what period do you think? How many years do you think you get to a steady state? So that combination of life management, and you go back and forth. So that's why I started at the beginning. You need to first understand where they are in the business life cycle. So if they are in the growth phase, Google tell you, I'm in the growth phase. I'm not going to scratch the surface. So for Google, right, you might have to break that rule around five years and maybe model like 10 years or something like that, to when they get to 8 years, when they get to the steady state. It doesn't mean you get it right, but at least there's a pattern to to you getting to where you're going. You just pick it from out of the air. There's a pattern to it. And so it's still starting point is to have that conversation with them. And they will try to convince you data and the rest on why they think they're still growing. That 5 years will not really capture where will be steady state.
I know 5 years. 5 year template really came from IFRS.
Yes, and that's just conservative because you don't want to have you don't want volatility in your P&L every year because because a lot of when IFRS is trying to fair value those assets instruments coming in our books is that some of them fit your P&L, the gain or loss. So you don't want to have that volatility. So IFRS kind of is a little more on the conservative side.
But if you're modeling or valuing an oil and gas company, right, and is basically has 10 producing wells, and it's very, very clear what the reserve values are for those producing assets. This one is 40-year lifespan, this one is 30-year lifespan, and they have an economic value test that they do to see whether it's economically viable for them to continue producing in those wells. So you could do a model or evaluation for 30 years. Would that work?
Yes.
Since you know the lifespan.
Yes. I mean, so that I mentioned that if you're doing upstream, you will. So there are things you will need to find out. It's just go back to the quality of your forecast and your model. So for the upstream business, so there's one that they call competent persons report, right? And that means someone independently has talked and done some tests around that your OML. And they say, fine, on this OML, you have 1 million barrels as results in here. So what that means is that if you are drilling and selling 100,000 barrels every year, hypothetically, that your model will stop at 10 years. $100,000 barrels every year times 10, 1 million about 10 years. You guys are when your license, even if you have 20-40 year license, the model stops at 10 years. But if let's say 10 million barrels that they have, 10 million barrels. So that means if you are doing 500,000 barrels every year, that means you have 20 years. And if your license has 13 years to go, the model stops at 13 years. So you need to understand. So that's why they say for the upstream is lower of license life or asset life. Asset life in this case is the reserve sitting in there. It still goes back to the quality that your modeling is important. You need to understand it. You understand so you need to understand each sector and how it works.
Mm-hmm.
You get that right, you've solved you solved like 50% of your problem. of the mistakes they are going to face.
Okay. Moving on, I think the next will be capex and working capital. People kind of conflate the two. Some even miss it out completely. You're growing and growing and growing without any capex to back it. Where's the growth coming from, right? I don't know.
Exactly. So this next one, there are about 3 errors in this. So the first two is a business is growing, right? Most times, every forecast, there's no way you forecast that your revenue will come down. You forecast that business will grow. And even though growing via capacity, via volumes, you grow via selling price, because selling price will track vision, right, and everything. And if you're going to grow via volumes, right, what that means is that means there's a level of investment required. So if it's going to grow via just price, you really don't need capex expansion. What you need is capex to maintain the asset. But you still need working capital investment. Which was that. So working capital investment means that pending when I buy raw materials, they ship it down, I convert it, I sell, and I collect cash. I'm out of pocket by cash. I need to fund it. If not, I'm in trouble, because in there are some things that will not shake. Some daily bills, salaries. There are some bills that will not shake that come every day. So you need to fund it. So that's what they call investment in working capital. So, like I said, you can use your supplier to fund part of it. What that means, as you're growing, you still need to increase your investment in working capital. So it's important. But if you believe, or as well as that, fine, there's a big market share untapped, I need to make that investment to increase my products I'm spending, the more products I'm spending. That means you need to also reflect that capex in there. So someone give me a model and saying I'm going to grow my volumes every year. Okay, what's your capacity installed? At the time you blow past it.
Yep.
You forgot to bring in the capex.
Very rosy. Let me ask the audience one quick question. Especially the experienced modelers or valuers in the house. Give me another reason why you could grow and your capex remains kind of steady. It's just maintainable capex. You're not doing incremental capex, but you're growing really rapidly. Tell me a situation where that will still be okay and not a mistake. Type in the chat. You're growing rapidly. Your capex working capital is not growing as fast as you are growing as a business, but it's still okay. Type a situation when that will be okay and not a mistake. Type in the chat. Let me see our experienced valuers, right? Let's see what you think. When is that situation okay? You're growing rapidly, your capex is still stable, kind of. Let me give you a clue. The situation is happening right now. So, let me see. Anybody? Any attempts? Experienced modelers in the house. Tell us now. Nobody's typing. I'll give you. Depends on the industry. This person is obviously Catherine is obviously a consultant. You know, Bola, when you ask a consultant a question, right? It depends is the best answer ever.
That's the safest go-to.
And no inflation, but you're growing. Okay, well, I don't think so. I'm looking for something else. When the service company, and its operation is not largely asset-driven. I like that. I know Luke Wakpo. Sorry, what are your name? He's saying when it's more. Let's say, for example, a service business like ours, and we have an LMS. We have a learning management system. We put trainings on it, and then you want to train 1,000 people. You can train 1,000 people with the same cost as 100 people, because the cost is there. It's already fixed cost, and you're growing. So I like that. You're a fixed cost heavy company, but there's still a limit though. In cases of SaaS company, they print money. Software as a service, they just print money. So it's possible. And again, because they build the assets, the capacity, adding one more person, a customer, in cost a tiny amount. Again, it's just fixed cost.
Zero cost of acquisition.
Yeah, very, very zero, a very low cost of acquisition, right? But there are other hidden costs. What you see with AI, right? Artificial intelligence is going to cause this. Artificial intelligence, right, is going to make things, our productivity levels can double and triple without very limited cost, no capex, very limited capex spend, and our productivity levels will significantly go up. So yeah, that's one of the ways that. But the thing is, what Bola we're saying is, you must defend it, right? You can't. But most times, what we see is that people just forgot. right? They forgot to grow capex to certain levels, right? But guess what? Research. If we are doing artificial intelligence stuff, there's probably going to be a big training course, lots of research to kind of improve. There must be some cost, but and again, if you're in that kind of gold mine, then guess what? Lots of people come into the market. You're not just going to make those on massive returns forever. People are going to come into the market, reduce your prices significantly, and prices will crash, isn't it? So prices of nearly everything are going to start crashing soon because of the effect of artificial intelligence. But so you can't make all the money for life unless you have a moat, unless you have probably a patent that kind of stops people from. I don't know what's this new drug that people are taking, Bolan, that kind of makes you healthy, makes you reduces fats without any work.
Ozempic, is it that one that
Ozempic. So if obviously they're going to have a patent on that thing, I'm sure. So they can continue to make huge amounts of money because of all the research spend that they had, but it's going to stop. The patent is going to end at some point, and then they come back to normal. So these massive returns only happen for a short period of time. Yeah, nice. Yeah. Back to you, Bolan.
Okay. So the other thing that you need to be wary of around working capital is that you know the way it is that so in finance, right? If let's say your receivables increase year on year, what that means you have more cash sitting out there. Do you know what I'm saying? Yes. So the way you put it in your model, especially when you're driving the free cash flow, is that you need to think through. So I don't like cramming formulas. I just need to think through. If I have receivables and my receivables is going from 100 to 150 next year, that means I am out of pocket by 50. My 50 naira is sitting somewhere else. That's of my cash sitting somewhere else. So the common error is that error of transposition. You get the other way around. So you now make it as if it's 50, you get 50. It's a common error I've seen. And what that means is you have overstated cash flow, overstated valuation, and if it's not picked before you release the report, that's a whole very embarrassing situation for you. So you need to think through when you're trying to calculate free cash flow, especially around the movement of working capital. That's another common mistake.
Nice. Next, we have discount rate inputs. Again, some very embarrassing errors happen here.
Okay. So actually now discount rate, right? Okay, so I'm just going to talk about CAPM, which is commonly used on capital as a pricing model. So that has like 3 components. It's good someone mentioned beta in there. You have risk rate. What that means is that at the starting point is if I can go and sleep in my house. Where can I put my money that I'm still collecting, make some money? So oftentimes by default, that's assumed to be government bonds. That's risk rate. Now the other thing is that so if I'm making an investment, right? So what CPM tries to establish is that if I'm going to invest in a company, what kind of order rates am I looking at? What kind of discount rates am I looking at? And that discount is to capture the risk profile of the entity, the risk I'm taking in the entity. So how do I derive that? There are different ways of driving this discount rate, but the most popular one is that CAPM approach, which is risk rate plus beta times equity risk premium. Now, equity risk premium is, I was saying that what kind of premium do I want for playing in the equity market in Nigeria? It varies from country to country. Different people have a different way of deriving that. I mean, if you want to be very cerebral and very academic, and you can regress over the last 10, 15 years. But the longer the data, the longer the years, the healthier, the better the data or the number you come up with. Some just basically take it from Damodaran. He tracks it twice a year.
Yeah.
Legendary and early March. And some have data bases that they pick it from, like where I work. So that's the other one. Then last one is the beta. Beta basically saying that mind you, the business are trying to value is private. But like I said, you need to use publicly listed companies like that as a proxy to derive what the discount rate will look like. And so part of that is the beta. Beta was the coefficient of businesses that are in that industry to the stock market. So if stock market
for those that don't know coefficient, those on modelers, just basically how do they move? When your stock market goes up by 10%, does your own risk or does your own growth go up by 10%?
The share price of similar businesses does it go by 10% as well? Is it moving?
Yeah.
So if it's 1%,
in the same direction. Yeah.
So if it's 1%, meaning that it moves in line with market. If it's more than 1, meaning so if market runs up by 1%. Our guy is running by 1.5%.
Then
So that means
beta
that's
is
very,
1.5.
very volatile. But if it's less than 1, that means regardless of what the market is, what the market is doing, business is just very, very. These are businesses sound fundamentals, and regardless of what's happening in industry or the economy, people just buy these products. So, i.e., when you look at beta, the telcos, the GSM, the cement business, the banks in Nigeria, basically less than 1.
Yeah. So typically, utilities have a lower beta.
Yeah,
No
utilities as
matter
well.
what,
Yeah.
you must.
We don't have many listed utilities business in Nigeria, so that is mentioned it. But I'm just talking about Nigeria. So those 3, yeah, the cement guys, because the belief is that infrastructure in Nigeria there's still a lot of infrastructure gap. So there's still going to be cement guys going to make money. So cement is very resilient. The breweries as well. For some reason,
breweries, I don't understand that really.
Why cement in Nigeria? In fact,
when you're happy, you drink beer. When you're sad, you drink beer.
In fact, that's why people drink the most beer. That's why the beer companies post stupid numbers. I don't get it. I've tried breweries over the years. I just can't wrap my mind around it. In fact, it's when we enter recession go and Nigeria everybody is paying. It's when that's when beer, that's when guys will declaring stupid profit. If you guys increase their prices,
they are very sad to drink more beer.
Inflation. They track inflation with their prices. This is it. You just crazy profit. And now as well the breweries. So those guys tend to be lower than 1. What that means is that regardless of where the market is moving, they stay lower than 1. What does that translate to? It means that by the time so hypothetically, let's say the equity risk premium is, let's say the risk-free rate is 10%. The equity risk premium is 10%. Then your beta is 1. Yeah. That means your cost of equity is 20%, right? When you have businesses that are less than 1, let's say the brewery is 0.5. So by the time you multiply 0.5 times 10, the equity premium, that's 5. 10 plus 5 means 15%. I know the rules. The lower the discount rate, the higher the value of the business.
Yeah.
So what that means is that the business perceives the business is less risky than others. Whereas you have some other businesses that are 1.5. So if 1.5, that your 10 equity premium now becomes 10 times 1.5. That 10 now becomes 15. 10 plus 15, 25% higher than the 20, higher than the 15. So that means the lower value at the end of the day. You can see the interplay and everything around that. Yes. So it's very important when you're doing beta to check that the companies are using are offering the same businesses. So
they're comparable.
So i.e., you can hear telecoms, but if you drill down, there's a distinct difference between GSM and CDMA. GSM is a better technology, newer technology. They make more money than CDMA. So people just use everything back. So you end up with wrong data, wrong beta, wrong value. So you need to understand that. Go back to the very beginning, understand the business are value, understand what they do. Then when you're not looking for comparables to drive that beta, you are picking the right ones.
Yes. So this moves to discount rate, and we can talk about discount rate and terminal growth rate. So those rates, your discount rate, your terminal growth rate, those two are inputs to your free cash flow to equity, free cash flow to finance. This is your income approach again we're doing. So you're kind of doing your fundamentals and getting all your valuations based on cash flows to the future that you're discounting to today. These rates are super important. Get them wrong. So, and many people argue that, look, we're just calculating to the answer. What answer do you want? Let's play with the rates, and then we value back to today and we get the answer you want, right? They do a goal seek or they do a solver and stuff like that. How do you stop making mistakes around discount rates and terminal growth rate?
So it still goes back to understanding the business, understanding the sector they operate in, understanding the data around that, so once you have that, so that means you are looking for the comparable companies that are similar to them, get a beta around there, which feeds into so risk rate is set. You can't miss that. But I also need to point out something. So now risk rate, with what happened to Nigeria, you need to be very careful around risk rate. In the past, we used the longest tenor bond. That would be all default to, because the views that business is to perpetuity, we use the longest tenor bond, 30 years. But the 30-year bonds that were issued were before the new government. So Cardoso has employed free float. He has tried to match MPR with inflation. So the 30-year bonds are not reflective of what the yield curve of Nigeria should be. Yeah. So right now, around 16%. Whereas the 10-year bond that they issued after Cardoso is CBN governor, came in, they are around 20 to 21%. So they have moved closer to what it should be. So that's why we don't use 30 anymore. Because what happens is if you use 16%, that's like 5% off what the discount rate should be.
Yeah.
That means you end up overvaluing. So those are things that you need to be aware of and track as well. The same thing with terminal growth as well. You need to do that. Then another mistake that I see is that most forecasts, because you factor in inflation and the rest, by default, those are nominal cash flows. So that means you need to have nominal input data in your discount rate and terminal growth rate. So you cannot be using GDP growth rate of 3%. Those are real rates, or 2%. You cannot use that as terminal growth rate. So as I mentioned, you need to use nominal rate. In the past, it was inflation. Then inflation was reasonable prior to 2014, when the first naira, the first oil, collapse of oil prices and the issues that we're facing.
Yeah.
So those are the issues around. These not all, they're not exhaustive, but these are the general ones that
there are quite a lot more. But let me add a little bit on the modeling side. So when you're modeling, a lot of times I see people modeling, they're modeling cash flows to the future, and they are not including inflation. So your modeling cash flow is going to go up by 2%, by 5%, normal growth as in real growth, and they're not adding inflation to those numbers. So those are going to be very unrealistic numbers going forward. And then here you're still taking your nominal cash flows, you're taking your terminal growth rates that you need to add an inflation head on that because you're doing evaluation in Naira. Now, if you're doing evaluation in dollars and you're getting cash flows in dollars, of course, you use the US inflation, US numbers, and then you discount that to today. But you need to be sure that those your cash flows in your model are actually realistic, are they based on today's money, right? Money of the day. But anyway, those are some technical stuff.
This border, sorry, go back. So there are two kinds of free cash flows that you have. The free cash flow to equity and the free cash flow to the farm. Free cash to the farm is cash flows that belongs to all capital providers, both debt and equity providers. While the free cash to equity is cash flow that belongs to those equity providers. So they have distinct discount rate that are using discounting them.
Yep.
So for free cash to the farm, you must use WACC. WACC is the weighted average cost of capital in comparison both debt and equity providers. While free cash to equity must discount using the cost of equity alone, as I just put out. And the mistake you see that people tend to like.
People kind of mix it up a bit and wonder, okay, why is it higher? Let's use the lower one.
Yeah, you need to.
Technically, WACC is supposed to be lower than the free cash flow to equity because equity is supposed to be the highest risk, right?
So
why don't you use that lower one? And that was WACC for free cash for equity, FCFE evaluation. Yeah, that's a bigger one.
The other distinct things around the kind of beta you need to do on liver beta. That's another story for another day.
Yes.
We're running out of time. Let's move to the
liberating beta and all of those stuff. Yes.
Yeah. I mean, those are things that David can train you when you're rolling.
Yes. So in fact, I'll even put that up while we're in the middle of this. Yes, we have an evaluation course coming for those that are interested, right? There's a huge discount for people that are in this house, right? Where you're going to learn this valuation, 4 cornerstones of value, IFRS 13, talk a little bit about it, and fair valuation, intrinsic value, cost, asset-based value. So basically what you've heard here, we're just going to go through a lot of the mechanics there as well to see how those things work, right? And what are those valuation mistakes and how to avoid them. June 16th and 17th, 2 days, register, get a 30% discount. See the bit.ly link, DBC valuation training. I think someone's going to add it to our chat. So you see the link on the chat. Quickly, if my team members could add that to the chat, and then you can click on the link and get your discount, right? So get that on. So if you're interested, register. There's a huge discount there. So people that are outside Nigeria, I mean, 357,000. I don't even know what it is in dollars now. Our currency has crashed tremendously. So you can really get that at an excellent rate. We're going to talk about the market approach very quickly. You know, there are 3 approaches. Income approach, I think, is the most popular, I mean, to me, it uses fundamentals. I really like the income approach. Fundamentals is what goes through, which means you're taking your cash flows. Because that's what value is.
Choosing value of a business, the DCF approach.
Yeah. So an income approach, you're taking the fundamental, taking the free cash flow all the way to the future and discounting it to today, which is to me what value is. Market approach, what do we mean by the market approach? Well, let's look at it. And there's something around what is the difference between value and price, but I'll come to that. So for the market approach, we're going to talk about comparables first. Comparables. What are comparables?
Okay, so for the market approach, right? Like I explained earlier, is the rule is that similar assets sells for similar valuation multiples. So I use the case of David buying orange or apple and let's use apple now in Ikeja, right? He buys like 5 for 100 naira. He has get the size of the orange and everything, and now goes to Lekki and this orange they are giving me this price at. This orange should be priced at same 100 naira. That's what it means. So what you do for the market approach is that as well there are different variants on that market approach. EV EBITDA, EV EBITDA P. So EV enterprise value by EBITDA, price to book, P ratio, but you need to know which one to use for each one. So the starting point is this, and that's very important, is comparables. You get it wrong. You end up with wrong multiples, value multiples, and you end up with wrong value. So I mentioned, so when and that's the mistake a lot of people make, is that when you're trying to pick comparables, you need to ensure that they operate the same kind of like similar macroeconomic conditions. They operate in the same industry. You can say they're all telcos, but then you find out one is GSM, one is CDMA. You need to move the CDMA and don't focus on, if your target is GSM, focus on the GSM entities. Or if you are valuing even within the consumer space, there's a distinct difference between the ones that there's distinct difference between consumer good manufacturers and consumer good retailers. There are two verticals. Retailers don't need capex, even capex, they're just selling. Manufacturers need capex, and they're all looked at and priced differently. So it's very important. As we go back to that same thing, know your target. Understand the business in and out. Understand I keep giving that word, key value drivers. So for instance, now for upstream, key value driver is the crude oil that are selling. For cement, is the value driver is the cement they're selling, which is driven by the capacity installed and the selling price. Capacity installed will give you the volumes they're selling and selling price. For hotels, is the room rate per night. For airline, is the seats they're selling, which flows to load factor. What load factor basically means is similar as capacity utilization, but for the airline, it's called load factor.
By the way, airlines are the worst business you can ever enter.
Yeah, how full is your plane? So you don't carry plane empty to and fro. So those are things that you look at already. It drives the forecast. So it's always very important to understand the business that they're trying to value. And if you get that
and
right.
There's some businesses that have multiple things. So there are multiple different. I think you may need to kind of do a composite value where you're valuing the separate businesses for businesses that have different things there. So I was talking to someone, we're doing a model. Say, how do you model something that never existed before? I said, it's not possible. I said, every single thing you see out there is a proxy. There definitely is some kind of similar business. So this app does this app does. At the end of the day, who are your customers? How are you growing? Okay, your customers are this. Oh, the customers are. I said, there's even another way to look at it. Okay, your customer is Mr. X that is 20 to 30-year-old in Lagos, Nigeria. That's your core customer. Well, you're also competing, even if you say you don't know precisely what the valuation, how to value it, you're competing with the person's wallet. How much is in the person's wallet, average amount in the person's wallet? What percent of that wallet are you trying to get? So you're competing, you could actually do evaluation where you're competing, the separate company, but you're competing with other companies that are actually trying to get to that amount of money in the person's wallet. There are different ways to think about this, but let's move on to valuation multiples. So what mistakes do people make here on valuation multiples?
Yeah, so we've sorted out the right comparables, right? Which is very important. Getting the right comparables, size, geographic location, and businesses. So the other thing, the other mistake that we say is that, and is very risky, is that different businesses have their own kind of like these unique multiples that they use in value them, nuances around that. So oftentimes, most manufacturing businesses, the approach is the EV EBITDA that they tend to always tend to use. And the reason why they use EV EBITDA is that they view that EBITDA is the closest in the cash flow to operations. So your EBITDA is your core earnings. So your earnings from your core operations of the business. So EBITDA, you guys understand the way you lay out your P&L, right? Sales, direct cost, less your operating expenses and everything. EBITDA basically means you strip out your depreciation from both your direct cost and your operating expenses to give you EBITDA. Because depreciation is based on accounting policy. You very spend that capex. And at the end of the day, if you look at it closely, the EBITDA kind of is not too far from your cash flow operations. So you always do EV EBITDA, and that's what you use for manufacturing businesses.
There's some, yeah. There's some businesses, please don't use EBITDA. They don't even have EBITDA, like banks and financial institutions, right? There's no point. Cash flow.
It goes back
I don't even
to
know
that.
what cash constitutes cash in the bank.
Understanding your business, or understanding the business, very important. Understanding the business doesn't mean just understanding better. Also look at the way the financials are stated and presented.
Yeah.
As people trying to recompute EBITDA for a bank, you just look the notes and now pull out a division and say this is operating profit, add division and this EBITDA. You don't understand the unique nature of the bank. Because the banks are set up right, banks can take up deposit liabilities. So in simple terms, a bank can leverage heavily.
Yeah, a bank is the most levered company you can ever have. It technically shouldn't exist.
No, because the license exist. Because license to them is leveraging people's money, deposit liabilities, savings accounts.
It's a money-making, legal money-spinning organization.
They can take billions of naira and basically use it to make money. So that's why, and banks, because it's also heavily regulated, right?
Yes, it has to be.
Is because banks are also heavily regulated, right? It makes them unique in that they are, what's the word now? They are they tend to have the same kind of like policies. So the reason why for my family business, why you use EBITDA is that anything below your EBITDA, right, is influenced by the person's accounting policy and capital structure.
It's also influenced by management. I'll just say it's a management.
Management. So it's influenced by the accounting policy and management. So that's why that's why for my federal businesses, you don't go below EBITDA. Because for instance now, company A, which is run by me, I can say, fine, my machines are Chinese. I mean, my machines, I want to do 10 years division of my machine. So let's say me and David both have the same business, right? We both bought machines at 1,000 machine. That's the cost of machine. I do 10 years, right? Life cycle of a machine. That means every year I'll be taking them on and on against my P&L, right? You get what I'm saying? So let's say we both make same EBITDA, 500 naira. I'll be taking 1 naira against my balance sheet. Against my P&L. So that means I will end up with profit before tax of 500 less 100. That's 400. David changes his own to 20 years. That means David will be taking division at half what I take. So David will now be 50. What that means, David will end up with a PBT of 450. So if I use the price to earnings ratio, I'm valuing David higher than me. Whereas that's not the case. We are both at the same par at the operating profit level. So at the EBITDA level of 1,000 of 500 each. So that's why it's risky to do for my family business. But whereas for a bank, they are heavily regulated. You don't see banks using different accounting policies, and there's no leverage. Yeah. That's why for banks, you tend what you see in value banks are the P ratio or price to book.
And typically, dividend discount models are what we use. So yeah. So dividend discount models are really what you can use to almost like free cash flow, because dividends is cash flow technically. So yeah.
So do you guys know why for banks is very common approach market approach is price to book? Because the view is that the net book value, the net asset in this case, which is the book that they call book for bank, that's the driver of a bank. That's what they borrow. That's what they loan out. So a very unique and way that people use in assessing in valuing banks from value market approach is price to book. You see, they don't use the EBITDA. You also don't find people using price to book for manufacturing business. So those are common mistakes. You need to understand the industry you are valuing, understand the nuances, and from there you not come up with the market approach. So multiple are used for it.
Okay. Last step in the market approach, we're talking about the average and median. So some people conflate it because average tells lies, right? All the outliers, it's just water them all out. And so it's kind of the distribution of your metrics. The distribution of your metrics is very critical, which you kind of don't see with averages. But you tend to see a bit of them with median. So what I see, right, I tell people when they're doing anything with averages, do the median of it. And if the median and the average are far apart, the data has a story it's not telling. And when the data has a story it's not telling, your valuation may be wrong.
There are noises in that data.
Yes, plenty noise.
Which
examples do you have? Which examples do you have of this in a big way that messing up evaluation?
I mean, so oftentimes when you pick comparable companies, right, you just found that there are, let's say you want to use the price book. It's all about the place, right? It's all about the place. But the bit about median is that median helps you reduce the impact or the effect of outliers. But for you to use the average, basically means you need to not clean up that data. Either you right size the multiples, that's the difference for that day, or you eliminate the outliers. So that means you need to come up with the criteria based on your target they are trying to value.
Okay.
So you got to put or where the bulk of the data is sitting. So if bulk of the data is sitting between 0.8 and 1 times book value, and you now have one guy having 1.6, 1.8. So that's an outlier.
Yeah.
So you eliminate that in deriving your average.
Yes. And then what I can add to that is this. Please, when you do those kind of things, and you often see those crazy outliers, those crazy outliers are things like, biggest one, of course, is COVID and some other things like that. So you need to add shocks into your model now, your financial model, and scenarios that have a highly unlikely situation of happening. Put that into your model and see how the effect is on your valuation. Right? Just do some of those tests. The subprime mortgage things and all those issues we had then, globally they had. They didn't do a stress test of when prices of houses are going to go down, when prices consistently go down, because they thought, okay, everything is tied to a house. Even if they default, we sell the house. But prices consistently went down, and they just meltdown of the entire economy. Funny enough, Bola, these meltdowns always come from the US, mainly US, and the entire world suffers it. That's kind of unfair, but that's another topic for another day.
They come up with crazy structures.
Yeah.
All to create money. And so they now build like it's like you're building on a faulty foundation.
Pie in the sky.
Everybody starts to cough. The whole world.
Yeah.
So, but the people came out of that thing making a lot of money. I mean, like Warren Buffett. He said, I don't buy things I don't understand. They asked him, how do you make, what are the guidelines that you use in deriving where to invest? The guy brought out a Coke bottle. Said, this, I know what it is. Yes. I know the products. I know the numbers. Nothing abstract here. I know how many tons of liquid they're selling. So, and I know the margin. So I know where they're going. So you don't see investing in all those funny businesses. You don't get them at all. Because
by the way, he also hates EBITDA.
And you crash.
Warren Buffett hates EBITDA. It's like EBITDA is a useless measure. So you can go online and watch what he thinks
very simple guy. So is you and that's simple thing. So whenever I'm talking to people, right? I mean, and I see them a lot. Guys said come up with one fanciful tech product. They are here to launch or they're about to launch. Then the data that used in deriving what the forecast is. So you can say, fine, I want to start doing a foreign remittance or doing foreign something. So you now can get the size of UK. Nigeria is just like UK. So if the size is let's say 1 million, and I take 2% or 5% of that amount, that's 50K, right? Okay. And if this price I make by products per week, just and by the time now convert it to naira, it's looking crazy. And I'm wondering where you come with this one from. So oftentimes I tend to run it from valuations at KPMG. I don't do startup for tech business because they are living on the cloud.
They're living on the cloud, or maybe 10% of them will eventually actually reach the cloud, or even maybe 5%.
And those ones take years. The money fund guy, you hear the story. It went one way, they blocked it, it came to another thing, and now he has arrived. Wow. And when you look at that whole business itself, without someone bringing telco into Africa, that whole ecosystem is in trouble. Someone did the pain and brought telcos to Africa.
Just for time management, let's jump to net asset approach.
You thought approach.
What is the net asset approach?
So what the net asset approach is, so this approach is used for businesses that are distressed, whereby the income approach and market approach is giving you values that are lower than the net asset. So net asset is saying that total assets less liabilities, and that's your net asset, and that's the value of the business. So oftentimes you see this for real estate businesses, for businesses that are distressed, we'll just write the value. Now, when you're doing that, right, the mistakes that people do is they just take, like I just explained now, book value. Just go and carry balance sheet, the most recent balance sheet, total asset, less total liabilities, and this is the value. And so, and that is historical cost. But most times, businesses on their books, they carry things at historical cost, not at fair value.
Yeah.
And that's the biggest mistake. So the starting point is that even though most of the PPE that they bought back then, especially with the way Nigeria has devalued, it's the business we carry that it's historical cost and be depreciating. So let's say they bought an asset for, let's say, $5 million 10 years ago. Nigeria is around 200 naira to $1, right? So that's about 2 billion. That's the asset, and they'll be depreciating over 10 years. So let's say even that asset, the market value is around, even the bottom million is around 4 million left, or 5 million left. Naira is now 1,800, so 1.6 or 1.5. 5 million times 1.5. That's like how much is that? That's like 12.5 million. You can see the difference. So the remaining value, if I'm to sell it now, is for $4 million. But because when I bought it 12 years ago at 200 naira to $1, I carried that 10 million naira. I've driven it down to what? So let's say, I've driven it down to, 10 million naira. I've driven it down to let's say half of the useful year. That's about 5 billion. But if I'm to replace that same asset now, in that condition, I'll be spending $4 million on it.
Yeah.
Naira is now 1.15.
Yeah.
That figure starts to go up immediately.
Yeah.
From what you will have been in your books. Do you know what I'm saying? So don't just historical cost. Learn if you value the PPEs. Especially with a country like Nigeria, whereby the valuation has kicked in.
Mm-hmm.
That's what I'm saying. So that is one mistake that people do. The other one that people do
is really ignoring off-balance sheet items, as you said.
Yes.
So they just leave out off-balance sheet items and some obsolete inventories as well.
That's a major issue. So they basically ignore off-balance sheet items, and that's very important. So what that means is that in your day-to-day line of doing business, you go into LCs, they don't see your balance sheet, but you're very committed, because once you open an LC, you're committed that you're going to pay someone. So, and when your customer on the other side is asking for an LC, I mean, I don't trust you. I want to know that, yes, I'm going to instrument that once I ship to you, you will pay. That's what I call letter of credit.
Yeah.
A bank is going to open on that side and guaranteed. Your bank we hold on to money, although they've not been telling you, but they hold on to it. So that's LC, but those balance sheet. Those are all balance sheets. Even there are lawsuits as well that will not appear on books until you pay until settled, and you pay the what's it called now? You pay the
I'll call it the fine. Is it a penalty?
Yeah, penalty. Yeah. Or even on funded pension. There are a lot of companies that will deduct from you and they will not remit, or they'll only remit your own portion and not remit the one that from the company should remit. So all those things. So you need to ask questions to understand. Even not everything negative. So they are positive. So maybe you develop the software that they are using, but you've not brought that value of that technology onto your books, because you didn't continue. So that one can be brought in as positive as well. So you need to ask, and you need to drill down. You get all those things, then they now quantify for you and now bring them onto your balance sheet. So the liabilities we sit as current liabilities, brought in. The technology we sit as fixed asset, brought in. So that the other one that we see is that so oftentimes people carry inventory. Most of those inventories, the market has moved against them.
Yes, completely. And technology has even moved against it as well. So technology moves very fast. It's already obsolete.
So you need to also check and find out. So if yes, you need to basically have that conversion and write it down or make or put a discount to it. So by the time you're done, you end up with what you call an adjusted net asset, which I think will show what the value of that business is based on all these adjustments, bring them onto the books. I think that would be that's it from my own end. I mean, this is not exhaustive. There are many more out there.
Definitely, there are many more. And the key there is, I mean, at the end of the day, it's what's value? I mean, you just have to understand, okay, so what exactly is value, right? And I've just kind of put this together. This is like the summary of what we've just said now, everybody. If you want to take a screenshot of it, you can, don't mind. So this is, we talked about income approach, market approach, assets, net assets approach, and these are all the potential mistakes that people make. And this is not exhaustive. I'm sure the list could be up to 100, right? So yeah, take note. Yeah. These are those kind of errors that we can make. Try and avoid making those errors, right? And yeah, if you want to learn more, obviously you need to come and do the valuation. You need to be able to attend the evaluation course, which is actually going over 5 weeks. So it's equivalent to a 5-day course, but it's virtual. So you're going to basically have 2 live sessions a week, and you have 2 assignments in between those live sessions over 5 weeks. And then you'll be able to learn quite a bit about the mechanics, general mistakes people make and how to avoid them. You get loads of materials and links to proper materials that you can use, all highly discounted. So again, the offer is on the screen. You can click on the offer and yeah, just click on the offer and register for our evaluation course. So if you want to learn more, and again, you can be from anywhere in the world, you'll be able to attend. So if you're abroad right now, it's virtual, so you can attend, and you'll be part of a community that will try and help you get better with valuation. So I will just take few questions. I know we've gone way over time. I mean, that's just how it is. We're passionate about this topic. We can talk about it from now till tomorrow, I'm sure. So
yes, yes.
Yeah. So who has a question? Let's see. I will just take 2 because I would have to leave. We're pretty busy. Oh, we have about 4. Okay, let me go through them. First question: what is the best practice? This is from Ayo Daily. What is the best practice on how to determine WACC for a private organization that has a negative equity? This is an issue I'm currently facing. So I have negative equity. And how do you calculate your WACC for a private company?
I mean, so there are 2 separate things. Negative equity is negative equity. So the WACC will be calculated using the normal approach, CAPM. Then that will give you the cost of equity, the cost of debt, after tax cost of debt. Then you now do the WACC based on the so the mistake people make. Sorry, this is another one. Is that when you are valuing a private business, right? They tend to use the book value of the equity and debt. That's an error. Because in practical terms, what the WACC saying is that, how do I fund this business, right? If I'm to fund the business, a project or an expansion. So that means if I'm going to fund a company of both debt and equity, how do I fund it? Mind you, equity, if I'm going to issue equity, you should have book value. You should have the market value. We don't have that, and that's what we're trying to determine. You usually have the market value of your shares. So that's what we're trying to determine. So rather, what people do is to use businesses that are publicly listed, go back to comparable companies, and when they gather them together, the ones that are, you started out to clean up data and everything, you end up at the debt to equity ratio. And the rule is that that businesses tend to, I mean, if the data is around this, that means most businesses in that sector tends to this kind of capital structure that is in funding any expansion or funding the business. So you use that debt to equity ratio as a proxy for a WACC. You never use the private business debt to equity ratio, because then those are book value of equity, not market value. So no business will issue shares on the book value. We issue shares based on its market value. And that's what we're trying to determine. We don't have that. So rather, we'll now use proxy of businesses that are like them, corporate businesses, and what their debt to equity is saying. So they're publicly listed. Because then their own share price is at market value. And so you use the debt to equity from there as a proxy to do your work.
Excellent. Let me quickly rush through questions. We have Ayobami Kale, right? He's asking if there's a recording. Yes, this is on YouTube right now. Ayobami, you can go to YouTube. You go to D Brown Consulting page on YouTube. You'll see it. Oluwatosin is asking, is there a training focused on upstream oil and gas, reserve-based lending modeling coming up soon? No, this is very specialized, right? So if you come to the valuation model, the evaluation course, you could ask those questions and we could then provide some answers to you in general. So this is very specialized. Yeah? Obviously, at the end of the day, what are you valuing? If you have a cash flow that's potential cash flow, so upstream, big problem we have in Nigeria, for those not in Nigeria, is a lot of our ISCs are leaving. They're kind of hands up and they're leaving. And they are the ones that have access to real large funding that we need for the amount of investments that we need into the oil and gas sector. We need huge amount of investment. Unfortunately, we didn't pass our law, PIA, early, and so they couldn't plan. And they're like that. They're leaving. So we have a lot of our local parties that are funding, are basically buying those assets up, but they don't have access to the huge funding required to get us back up to probably 2.5 million barrels per day, which is...
They've already spent money to even acquire those assets of the IOCs. So to not get money to expand, and that problem on his own.
Expansion money is very key. How do you get that money?
They've leveraged already to buy those assets. Unlike the IOCs, whereby they can draw money from that global parent company and next nothing rate.
Yeah. So another question is, how can we determine an assumption for a line item with an outlier? Okay, I think we talked about that. So line item with an outlier. Outliers are not forever, right? As Bolan said, you can probably take out those outliers, understand the driver. I'll give you an example. Very simple example for modeling, cost of goods sold. Cost of goods sold is driven by sales, regardless. Now, when you take the assumption over, let's say, last 3 years or 4 years, you do cost of goods sold divided by sales, cost of goods sold divided by sales, right? If the numbers, let's say it was 54% year one, 52% year two, and then 30% year three, there's obviously no trend. There's a problem there. Your data is dirty. You need to go to cost of goods sold and clean it, or there's something fundamental that has happened.
Something happened that year.
But the driver is sales. You can't say, oh, let me use something else, cost of goods sold divided by net assets. No, the driver is definitely sales. Something else is going on which you need to find. So you have a lot of work to do. Go and read the notes to the accounts. Go and read chairman's statement. Are they now a trading company? Who knows? Maybe the company has changed to something else. So it's work. You have more work to do. So how can we determine? Okay, Oliver is saying the best, or Ayodele is saying the best. Well, it's answering someone else's question. Very good. So the best practice is to normalize your data. Thank you, Ayodele. You see, we have some master modelers here and master valuers. He said exactly what I was saying. Last question by Shegun Adams. Is it important to adjust market multiples by country risk premium when doing a market-based valuation involving multiple countries? Last question, Bolan.
Yes. So. I mean, there's a valid point, but you need to come up with a tool that will not value penalize. So the starting point is where we're getting data from the market risk country risk premium, right? Sorry, can we adjust the?
Yeah, he's asking, is it important to adjust market multiples by country, right? So the market multiples are adjusted by country risk premium when doing a market-based valuation involving multiple countries. So you have multiple countries, you have a market, and then are we going to adjust them when you're now bringing it all together?
Yes. So in here, right, we have a tool, right, that allows you to make the adjustment based on location, size, risk, and rest. So I mean, you need to develop like a template, which go back to modeling, that kind of like, and you just don't pick one year. You need to understand the correlation between the countries you're looking at. They are what's it called now? They are various countries premium, and what it is, and the kind of multiples vis-a-vis target you're trying to value, or the country, or against similar businesses operating in that country whereby your target is. So once you find a correlation, then you can now say, fine, based on that, I can make this adjustment. So let me give an example. So we're trying to value, and this is not what I said, but it's something similar to that. We're trying to value, some years back, we're trying to value life businesses, right? A life business. What we found out was we just didn't have enough listed life business. What we found out, most of the insurance companies were composite and a few general. So it was a challenge because we just didn't have enough life businesses already there. So we had to become creative. So what we did was to start looking at the data around between historical growth rate of life versus composite. Look at the forecasted growth rate of life versus composite. What we found the correlation. The discount between those two growth rates. We found that it was not too far from each other. So that allowed us to come up with a discount that we're going to apply to this composite to give us what the implied life business will look like. But it's important. So even after we did this, we want to explain and write what we did, the data, how we have what the data when we did that correlation and everything. We saw that they were moving with each other around this kind of discount, and so we applied it. So we now put all the various composite in there, apply the discount, and this is what's given to us. And so based on that, we have used this one, apply this multiple against the life business value. So there's a lot of work. The thought process makes sense, but you just don't pick one data point. You might need to go back to know is there a correlation between the various countries and CRPs, and also in line with the multiples as well, between that alive entity and a similar Nigerian entity. Imagine you're trying value business in Nigeria. But where I work, they've done that over the years, and they've come up with parameters and an Excel tool that helps us. So just put this from CapIQ and plug it in there, and it generates what the quantum of discount should be.
Yeah, and that's true. So there are tools out there that you can actually pay subscriptions for, and you'll be able to get some of this data, so you don't do all that heavy lifting. But please understand what they are getting from them, that you can explain it, you understand it. It's not just a black box. And maybe actually, Bola, where can people reach you? Some people here probably have some big valuation projects, and they would like you to help them. I don't know, how can they reach you?
I'm on LinkedIn. You can find me via LinkedIn. Just drop me a note on LinkedIn.
Yes, so drop Bola in the notes, and then you make sure KPMG gives you a nice discount, I'm sure, or at least just say you attended this webinar and you need a discount, who knows, to get something. But truly, if you don't want to have stress doing a major valuation project, I advise you talk to Bola and his team, or you go around different places and then you have to still come back. But at the end of the day, you need a good job. You need to pay some money for that good job, right? So you could learn how to do it yourself. But really, if you have a big project, it's nice to learn yourself, but please do hire the excellent people like KPMG who can be able to help you move forward faster, right? So with that, I don't think it's one more question. I don't know if you want. When converting from equity to enterprise value, how do you treat deferred tax asset and deferred tax liability? Shukura Abdullah is asking that. Converting from equity to enterprise value, deferred tax liability, how do you treat it? So, I'll let you answer that.
You also need to investigate as well. And the beauty about working for a KPMG is that you have experts in different sectors. So these are this one we tend to. So we have a team called the accounting technicians. So they will dig through it, and they now come up with. So they now come up with how to treat it, how to make this. I can give that. It's not a space that I know. So
for me, I go back to first principles. So where is the tax? At the end of the day, tax is borne by everybody, whether you're an enterprise or you're equity. You bear the tax. Tax is something you pay. You get at the end of the day, working at weighted average cost of capital or your equity value. There's still a tax element there. There is a tax for weighted average cost of capital. Of course, debt has that shield, right? That tax shield. At the end of the day, deferred tax means it's deferred. It's either that you have paid it and you're going to owe it in the future, or you've owe it and you're going to pay it in the future, right? So again, those cash flows, you could say that at steady state, it won't be any deferred tax and it's just going to be steady state. Everything is nice and hunky-dory. But at the end of the day, there's a cash effect there. So you need to do quite a bit of work on that cash effect. Calculate it, so do a bit of tax modeling. If that deferred tax asset or liability is heavy, is material, you need to do some work for sure. You need to break down how it is calculated, how it's going to come out of the system or for the system going forward. And sometimes it's not. Sometimes it's a balancing thing and no effect for the next 10 years. If there's no effect on the next 10 years based on your modeling of tax, when you discount something 10 years ago to today is almost nothing. So again, you make your choice. Is it material enough for you to crack your head? Let me tell you something about modeling and valuation. At the end of the day, you're wrong. Highly unfortunate, yes. At the end of the day, you are wrong. You're not right, but it's a good guide. And you have a kind of a football field of value, right? That you're going to then advise your client between this period and between this range and this range. Deferred tax won't change that unless it's a hugely material part. And if it's a hugely material part, is the business really the deferred tax somehow, or what are the cash flows coming into the business? So thank you very much, everyone. This has been great. I want to say big thank you to Bola for being our guest at this webinar, and also big thank you to everyone that has waited all this while to finish. Sorry, we went over. I think this kind of webinars is 1.5 hours, not 1 hour, because we really wanted to go deep into it. So thanks, Bola. Thanks, audience, and thanks.
I really enjoyed my time here. I mean, thanks for having me as well.
Yes, and thanks to everybody at the back end. We have an excellent ground team.
Find me on LinkedIn. Just drop me a message.
Good. So just check LinkedIn and drop a message. Even if you don't have a job right now for Bola and his team, at least conversations. I'm sure Bola likes to share his knowledge for free, as in like this. Thank you. And so you could gain something from him. And maybe you know someone with plenty of money that will need his services, then push them over. So thank you so much, everyone, and looking forward to the next one. Thanks, Adewumi. Thanks, everybody in the back-end team. Thanks, Oluwatobi Loba. Thanks to Dami. Thanks to Oluwasegun. Thanks to Victoria, and everybody else in the back-end team. Thanks, Joe.
Thank you.
Bye-bye, everybody.
Bye, everyone. Bye.